All right, welcome to Peace of Mind Radio. I am Brian Ramsey, and I'll go reverse this time. That's Aaron McAndrews, and that is Eric Douglas. And today is an interesting topic. This is one that we've touched based on real estate before. We're going to go back and touch base on it again, only because we're in a wacky world when it comes to real estate, right? Would you guys not agree?
Yep, for sure.
It is. I mean, I'd say even more in the pandemic and even now that people are like, okay, it's all good. We are in a crazy real estate market. So we thought we'd touch base on it because there's a couple of points that everybody should know when it comes to their real estate or their home from a planning perspective. That's really where we're going to address it, okay? So first of all, one of you two just take it and talk about how crazy, wacky the real estate market is. By the way, it is middle of July in 2021, just for frame of reference when we're recording this.
Well, I mean, I'll just talk about my area of town that I live in.
Yeah.
I'm outside of J-Town, kind of right around the Snyder off Taylorsville Road. And, there's my entire area of town. Virtually every house that's on the market is currently contingent or already pending. I mean, and the number of houses that's available is really, really low. So part of it's also driven by the part of town that you live in, but I'm definitely in an in-demand part of town, and I'm seeing, I can just even give anecdotally, my neighbor's house got 3 aggressive offers last week and was sold in a matter of days. I think a lot of realtors you talk to are saying that it's starting to slow down a little bit, but when you say that it's slowing down, instead of taking 1 day to sell, maybe it's taking 3 or 4 days to sell.
Well, that's right. Yeah, it's still selling quick. Yeah.
Yeah.
Yeah, we actually did move right before the pandemic hit. So we bought our house now, and we looked at it, made the offer, purchased it or whatnot, and then all of a sudden the Tuesday or I think it was a Tuesday, I believe. Anyway, the world shut down, and we still had to turn around and sell our other one. So I was a little bit worried about that, but. Even then, once we listed it, 3 days passed and it was gone, and that was before it got really, really crazy.
Right.
Since then, like the reason why I was saying this story right now is because I've only lived in this house for a little bit over a year now, and over the last several months, I've had random realtors calling me, offering. They've got clients that want to pay cash for the house, and it's above where the market value is and everything, and it's just crazy. So, but you got to think about that. If that's all great, but where are you going to go? Because there's not a supply out there right now.
My wife and I have had that conversation, as a matter of fact. We've kind of joked around, you know what our house is worth now? I mean, we only bought it back in 2019, but we could sell it at a premium and definitely make money on it just even a couple of years in. But on the flip side, we've got 3 kids. It's more of a pain in the butt to figure out what we're going to do if we were to sell it and take a profit on it. So.
Yeah. So the market's kind of crazy. It'll settle out over the next year because it's really supply demand type thing. There's just a lot more demand. Just happens to be the environment we're in. There's a lot more demand than there is supply, but that'll all settle its way out, and you won't see this $50,000-$75,000 above asking. It's just not. That'll settle down, but right now that's kind of the way this wacky world is. We had a client that got $75,000 above asking. So, and it's funny, the conversations that these realtors are having with clients when they're putting their house on the market. They're like, hey, we think your house is worth, I'm going to make up a number, $350, but let's price it at $340 so we get a ton of action, and you're going to get way above the $350. That's how they're doing it. It's a psychological thing too. Yeah. So it's crazy. But anyway, all right. So that's just sort of an overview of our take of the real estate market. But really what we want to talk about today is from a planning perspective, when clients come in and we're talking about paying off a mortgage, paying down a mortgage, what we want to know is, or what's our advice we typically give clients. So let's just take each one of them as a one-off, and we'll just kind of round robin our thoughts on it. So the first one is, and since we are sort of Dave Ramsey providers here, paying off your mortgage. Let's take that one. When a client comes in and says, I have got to pay my mortgage off, or should I pay my mortgage off? What's the common...
Well, first question I have is, what's your interest rate?
Yeah.
And I've had, I know 3 clients specifically I've had this conversation with where I've asked them, what's your interest rate? And they've told me something in the 4 to 5% range. And I said, okay, well, it might be better off if you look to refinance and get a much, much lower rate and go ahead and stick with that rate for a while versus trying to pay off X amount of money every single month. Because so much of what we see is psychological versus logical. I can tell you on paper what the logical decision or, what the logical thing you should do should be. But when you think about psychologically, so many clients, want to have all their debt paid off, right? And so you have to weigh that. We kind of, and that's really understanding where your client is, what their concerns are, and what's important to them. But ideally, my first question out of the gate is, tell me what your current rate is.
Yeah.
And because ultimately it becomes a game of, can you make more than that somewhere else?
Yep.
I agree with Eric. That's the first question that I always have is what are they currently paying? What's their rate? And then the second question I usually follow up with is, how are you going to pay it off? What are you using to pay it off with? Yeah. And if it is that we just have an abundance of cash sitting here on the side and we're going to or we got an inheritance with some type of cash or whatnot, and we're going to pay this off, the question then comes is, what kind of rate could you be earning on that cash? So, that becomes a different conversation at that point from an investment standpoint, from a planning standpoint.
I think it needs to be a question of what the alternative specifically is, because if the alternative is you go spend the money somewhere else, then that doesn't help anybody. That's not part of a good financial plan. But if the alternative is taking that extra, let's say $500 a month that you would pay down the mortgage on, invest it somewhere, especially if you have long-term growth potential that can realize, let's say, a greater than 3-4% interest rate over a period of 10, 15, 20 years, whatever the case may be, then on paper, logically, that's going to make more sense. Yep.
Yeah, the one thing I'd say is so we're really talking about paying off a mortgage, which would mean you'd have some sort of lump sum of money. I probably should state that up front. So if you pay off your mortgage, you have a lump sum of money that you could then pay off your mortgage. So again, it goes back sort of what Eric's talking about. We always have that conversation of, you have this pool of money, where is it most effectively in use for you? Mm-hmm. It could be that it is paying off your mortgage, right? But it also could be that if you're, I think the average 30-year mortgage is, 3%, a little less than 3%, I think, at this point.
It's less than that, yeah.
Yeah, because the 10-year went down to 1.3 the other day. Did y'all see that? It's crazy. But anyway, so if we're paying 3, but we can take that same amount of money and put it in an investment and make 5, you're much better off making 5. And then if you ever get to a point where interest rates, or you're not making 5%, because your risk profile changed or whatever the case, and it's almost equal, then you're much better off taking that pool of money and paying off your mortgage. And so what we've done over the years is we've said, okay, you've got, I'm going to make $200,000 mortgage, but you got $200,000 in cash. You could technically pay your mortgage off. You can arbitrage the interest rate by keeping the money invested up to the point to when you get into retirement. So let's say you've paid down half of that. You get to the point you're 65 years old. You got $100,000 mortgage, but you still got way more than $100,000 because it's been making more than what you've been paying. Then you take $100,000 out, pay your mortgage off, and you're free, right? That's the proper strategy. It's not just, I'm 50 years old and I'm going to unload all this money and pay off your mortgage. I just don't. But again, there's two parts of every financial decision. One is the logical part, as you say, which I say is the number side, and then there's the emotional side, which is difficult for us to manage there. So I'd say all in all, it comes down to, when you're paying off your mortgage in a lump sum, it comes down to, where is the money most effectively used? Is it paying off the mortgage, or is it in the market? Yep. Making more than what you would make, more than what your interest rate is, right? Mm-hmm. All right, so that's it. Now, the second piece, which is more often the case of a conversation than paying off in a lump sum, and that is, should I be making extra mortgage payments every month with my money? So tackle that one. What do you typically talk about?
So it's kind of the same for me, from a standpoint of where they at. What is your interest rate on your mortgage? Okay, how much extra are you going to be wanting to put towards that, and where are you getting the extra from? Is it just obviously cash that you're talking about? Is it a lump sum of savings money? Is it money that's coming just from your paycheck? How are you doing that? And then you weigh that based on the rate and say, okay, how long am I going to plan on living in this house? How long am I going to be there? Because, for example, for myself, I just bought that house, and I don't plan on leaving that. That's going to be the last house we're probably going to have, and we'll live there, forever. So me paying extra on that mortgage when it's at 2.78% or whatever right now, I can put extra money into the market every single month and allow that to grow based off of my risk tolerance and my portfolio that I have now. And then down the road, if I want to get that mortgage paid off or whatnot, now that money has earned and worked for me. So it really depends on their situation and what where that's coming from, and obviously where they're at in their career and their life and what their goals are. So that's kind of how I handle that.
Yep, that's the key. I mean, what's the alternative? So it's one thing to say, okay, it's not worth it to pay off your mortgage early to make extra mortgage payments, but you have to have a plan. You have to have a very specific alternative, because we have to weigh option A versus option B. Right? Because we can't just say, oh, well, if you invest it, well, what are you going to invest it in? Where are you going to invest it? Because there's all kinds of different tax treatments for different types of investment vehicles, right? So we need to have kind of a plan B and weigh what each plan looks versus one another. But I can tell you this, when we run the projections, the cash flow projections in our software, there's all kinds of different ways we can do this. But when we illustrate very specifically, okay, well, you tell me you want to make an extra $500 a month on a mortgage payment each month. Well, let's just map that out. When would you have that paid off? And let's see strategically, does that make sense? Does that what type of effect does that have on your long-term financial plan? Okay, well, this is what happens if you make an extra $500 a month mortgage payment. Okay, let's look at option B and invest it in, let's say, a Roth IRA, right? Yep. And let's take it and let's invest it in a Roth IRA. It grows tax deferred. It comes out tax-free in retirement, right? So how does that affect your financial plan? And then we have option A, option B, and we can make an informed, educated decision. That doesn't mean if option B is better than option A, you always go with option B, because going back to the psychological part of it, the behavioral aspect of investing and finance is huge, and we cannot we cannot underestimate that. I mean, I've got a client right now that's sitting on a boatload of cash, and she's comfortable with that, and she can't get over the idea of possibly losing that money. So that's fine if that's what makes her feel better. And no matter how many times I give her different options, it's not going to change her mind, because that's how she sleeps at night. So
So I obviously totally agree with both of you. I'll add one caveat to that, is that I'm a firm believer that if you want to make an extra mortgage payment, totally fine, but there's things that we need to do first. First of all, you need to make sure that you're paying yourself. You have got to make sure that you're saving enough money every single month, or however often you get paid, so that you accumulate the money that you need to then, when you retire, that money pay you for whatever it is, the amount that you want to get paid from there until the end of time. So as long, and we can run projections, say if you're saving X amount of dollars per month with the average growth rate, you will have accumulated the amount of money that you need to then live the life you want to in retirement. If you can do all that, and you got an extra $500 a month, knock yourself out with paying down your mortgage. But here's the issue with here's what I find is the biggest issue. Most people don't save enough every month, first of all.
Mm-hmm.
Nope. So they don't save enough, number one. But number two, they'll pay an extra $500 a month or $250 a month towards their mortgage. They're by God, they're going to get their mortgage paid off. Then they get in retirement. They don't have enough assets to produce the income they need. They're living in a house for free. But you can't take a chunk of your house and go to Kroger. You can reverse mortgage. We all know that. But that's like the least attractive thing.
We're not hawking those here.
Yeah. But you can't take a chunk of your house and go to Kroger and buy groceries.
Yeah.
Right? You can't go on vacation with your house. Yes. Somebody's going to text and go, well, there's always lines of credit. You're right. There are ways you can get equity out of your house. But that's like the least attractive thing you can do. The most important thing you do is find how much you need to save every single month so that you can accumulate the money that you need to then produce the lifestyle that you want in retirement. And then if you've got any excess cash flow, if you want to put it on the mortgage, knock yourself out.
Tell me what home home equity lines of credit rates are going to be in 15 years too.
Who knows? Yeah,
right?
Absolutely.
And then all you've done is giving yourself another monthly payment.
Right.
So you're not living there for free anymore. You're
right.
You're borrowing the equity that you worked so hard to pay off.
So you're back to square one.
Yeah.
Yeah.
Well, and actually, you raise a great point too, because we probably should have mentioned this already, but tell me what you're currently doing already, right? If you want to sit here and tell me that you want to pay off your mortgage early, but you still, you just went out and bought a truck and you got a $40,000 loan on a brand new truck, or you've got high interest credit card debt out there, or something, you got some other forms of debt. No, it is not in your best interest to pay off that mortgage early. You need to get that other stuff taken care of first. That's the debt snowball that we talk about, right? Take care of your smaller, higher interest debt first. Get that knocked out, because that's going to be a far bigger hindrance to, hitting your long-term financial goals than, paying 2.5-3% on your mortgage rate.
Yeah. Yeah. So I think that's the point why we brought this up is that making an extra mortgage payment, paying off your mortgage, is it a good idea? Yeah. I mean, we all want to be in retirement but it's not always the worst case in the world. I have run many a scenario with folks that are in retirement that I say, well, your cash flow more than covers your mortgage payment. Continue to make your mortgage payment, right? It's not that it's the worst thing in the world to have a mortgage payment when you get into retirement, as long as you can cash flow it. As long as you've done what you need to do and accumulate the money you need to accumulate to give you the lifestyle that you want in retirement. Sometimes that involves a mortgage payment. Not that big a deal. Ideally, we'd want to have everything paid off, but that's not always possible for everyone. And so the point is, save early, save often. That way you can, have your options when you want to retire, whether you pay off your mortgage or not, right?
Well, that way too, if you do the planning on the front end, these academic exercises that we're having about is it worth it to do this or that, they become academic exercises, right? And we're trying to figure out the best option for you versus you being over-leveraged in your house or whatever other type of debt that you have, and you really don't have any options at that point. So
the key thing that I'm hearing from everybody here is the planning. Just having that plan.
Absolutely.
You got to have the financial plan. You got to have the plan. If you have a mortgage payment in retirement, you have a mortgage payment in retirement. But just like you said, as long as you can cash flow it.
Yeah. Yeah, and I will tell you that, what's surprising to me is more people newer clients, right? The new clients that we get will come in and we have these conversations about mortgage and paying off. And they go, well, I always was told to make extra mortgage payment. I was never told to look at this any other way. And that's part of what we do is we want to make sure we educate clients about all aspects of their financial life, because it kind of goes back to our company motto or whatever you want to call it is, the more educated a client is, the better financial decisions they're going to make, and better financial decisions lead to better results, right? So, I mean, it's very common sense, but you have to educate clients about all aspects of their financial life, including paying down a mortgage. It's not necessarily just investing in a widget, this widget over that widget, or this fund over that fund. That's it's important, but it's not the most important thing. It's more so about educating clients across all aspects of their financial life so they can make better financial decisions. Yeah. That's kind of what it's all about.
It's conventional wisdom, right? Saying you need to pay off your mortgage early. Well, conventional wisdom isn't always right for every individual. Same thing, like the conventional wisdom tells you, you need to max out your 401k every year. Not always, depending upon what your situation is, right?
Yep.
So
for
the answer is always it depends, right?
Yeah. All right, so listen, we'll just wrap that up here. So that is another week of Peace of Mind Radio. Keep in mind that we have 3 other podcasts. We have Peace of Mind Radio, which is more the financial-related stuff we just went through. We have Connecting the Commonwealth, which is we highlight different small businesses and their products and services around town, which is a really cool one. And then we have Burgers and Bourbon, which is our favorite, where we test and sample burgers from around town and bourbon. We usually do that on Friday afternoon. In full disclosure,
maybe we just need to start doing like crossover episodes.
Yeah, that's right.
Burgers and finance, or bourbon and stocks.
Yeah, exactly. So anyway, we appreciate you listening. And if you got any comments about a show topic you want us to do, make sure you let us know. Drop us a comment in the comment section. Our phone number, if you are listening to the podcast, is 502-200-5210. We offer every prospective client free consultation. So if you just want to come in, and even if you're working with another advisor, that's perfectly fine. You want to come in and meet with us and say, hey, I just want to know how you guys may do things a little differently or what it is that you guys do. We are happy to sit down and give you an hour of our time. It's worth your investment. I can promise you that. So anyway, call us, come see us, and we'll be happy to sit down and talk to you.
Yep. Check out Peace of Mind Radio on every major podcasting platform, Stitcher, Google, Spotify, Apple, wherever you get your favorite podcasts. Leave us a review and a 5-star rating if you don't mind. If you're watching on YouTube, check the red box to subscribe to all of our latest videos so you can be first to be notified when we drop something new. Otherwise, we appreciate you listening.
Have a good week.
The information given herein is taken from sources that IFP Advisors, LLC, doing business as Independent Financial Partners, IFP, IFP Securities, doing business as IFP, and its advisors believed to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. This report may not be reproduced, distributed, or published by any person for any purpose without IFP's express prior written consent. Securities offered through IFP Securities, LLC, doing business as Independent Financial Partners, IFP, member of FINRA and SIPC. Investment advice offered through IFP Advisors, doing business as IFP, a registered investment advisor. IFP and Family Wealth Planning Partners are not affiliated. The information given herein is taken from sources that IFP Advisors, LLC, doing business as IFP, IFP Securities, LLC, doing business as IFP, and its advisors believe to be reliable, but it is not guaranteed by us as to accuracy or completeness. This is for informational purposes only, and in no event should be construed as an offer to sell or solicitation of an offer to buy any securities or products. Please consult your tax and/or legal advisor before implementing any tax and/or legal related strategies mentioned in this publication, as IFP does not provide tax and/or legal advice. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors.